Before we begin, a critical reminder. I am not a licensed financial advisor, CPA, or attorney. This video provides general market analysis and educational content only and does not constitute investment advice. Precious metals are speculative assets which may experience significant price volatility. Please consult a licensed professional for tax, legal, and investment advice specific to your situation. Introduction: the Barometer of Sentiment. The gold-to-silver ratio, or GSR, is one of the oldest financial metrics in history. It is simply the price of 1 ounce of gold divided by the price of 1 ounce of silver. The result tells you how many ounces of silver it takes to buy 1 ounce of gold. But this ratio is more than just a calculation. It acts as a powerful barometer of economic sentiment, a tool for understanding whether the market is shifting toward fear or optimism. We are going to deconstruct what the ratio is signaling and how different economic conditions push this ratio to historic extremes. Section 1. The Foundation: Why the Ratio Moves. To understand the GSR, we must first understand the fundamental differences between the two metals. Gold, the monetary metal. Gold is primarily viewed as a store of value and a hedge against systemic risk, inflation, and currency devaluation. Its demand is driven by central banks, large institutions, and long-term saving. Silver, the industrial metal. Silver, while also a precious metal, is heavily tied to industrial demand, particularly in electronics, solar panels, and medical devices. Roughly half of its demand comes from manufacturing. Because silver's demand is tied to industrial growth, it reacts much more violently to economic shifts than gold does. Section 2. The Extremes: Signaling Fear versus Optimism. The ratio doesn't just measure value, it reveals the market's risk appetite. We will analyze what the two extreme conditions indicate. A high ratio, the fear signal. What it looks like: the ratio is high, e.g. 90 to 1 or 100 to 1, meaning it takes a large amount of cheap silver to buy expensive gold. What it signals: fear. In times of economic recession, crisis, or systemic uncertainty, industrial demand for silver plummets. Investors rush to gold as the ultimate safe haven, causing gold's price to rise faster than silver's, pushing the ratio up. The market is choosing stability over growth. B low ratio, the optimism signal. What it looks like: the ratio is low, e.g. 51 or 61, meaning it takes a smaller amount of silver to buy gold. What it signals: optimism. In times of strong economic recovery and high industrial activity, silver demand skyrockets for manufacturing and technology. This drives silver's price up much faster than gold's, pulling the ratio down. The market is choosing growth and utility over safety. We can use the GSR to put economic narratives into context. During the global financial crisis, 2008 to 2009, the GSR spiked dramatically as investors liquidated risk assets like industrial silver and ran to gold, confirming peak systemic fear. During industrial booms, periods of high global growth are often accompanied by a tightening, lower GSR as industrial demand accelerates. The GSR is a historical gauge. Its movement should be viewed as confirmation of a prevailing economic sentiment, not a direct signal for action. The gold-to-silver ratio offers a fascinating insight into the psychological and economic drivers of the metals market. It's a foundational piece of analysis that helps you frame conversations about inflation, industrial demand, and global uncertainty. We successfully transformed a complex trading strategy into a compliant educational analysis tool. What other complex financial indicators, like the VIX or the yield curve, would you like us to deconstruct next? Let us know in the comments. Subscribe to the Capital Blueprint for more safe, foundational financial education.